weeks. What is it that you want to do differently?
I think the most important thing we do as a company is build a culture that we're all proud of.
Four students, a $2 million loan from their old classmates, and an idea that Wall Street laughed at. That idea is now a publicly traded company worth billions. Its name is on a stadium that hosts Super Bowls, and by the end of 2024, it had over 10 million members. But here's what makes this story different from every other startup beats the big guy story you've heard. These four weren't trying to build a tech company. They were trying to build something. Wall Street had completely forgotten how to do a financial institution that actually gave a damn about the people using it. Before they showed up, getting a student loan meant walking into a bank that looked at you like a number on a spreadsheet. Didn't matter how smart you were, how hard you'd worked to get into a good school, or where you were headed. They looked at your credit score, or more likely, your parents' credit score, and made a decision in about 30 seconds. The system wasn't just cold. For millions of students, it was completely broken. In 2011, 4 students at Stanford Business School decided to fix it. This is how they took on Wall Street, and won. The year is 2011. The financial crisis is still fresh. Banks are still rebuilding their reputations. And quietly, almost without anyone noticing, American student debt is about to cross $1 trillion. And the system handling all of that debt hadn't really changed in decades. You needed a loan, you went to a bank. The bank looked at your credit history, set an interest rate based on blanket rules that had nothing to do with who you actually were, and sent you on your way. Future, earning, potential, irrelevant. The degree you were working toward didn't matter. To the bank, a first-year med student and a dropout with the same risk profile. Mike Cagney, Dan Macklin, James Finnegan, and Ian Brady were sitting at Stanford Graduate School of Business, watching this play out around them. These were some of the brightest students in the country, people who were clearly going somewhere, and they were still being treated like high-risk borrowers because they hadn't built a credit history yet. And one of them asked a question that sounds simple, but was actually kind of radical. What if you didn't need the bank at all? What if, instead of borrowing from a faceless institution, students could borrow from people who actually understood their potential? People who had walked the same halls, sat in the same classrooms, built careers from the same starting point. What if you could connect students who needed loans directly with alumni who wanted to invest in the next generation? They called it social finance. SoFi, for short. And at its core, it wasn't really a financial product, it was a bet on community. Here's what I love about how they started. They didn't go pitch venture capitalists. They didn't rent office space in San Francisco and hire a team of engineers. They went back to their own community first. They launched what they called the Stanford Pilot Program. The pitch to alumni was unlike anything anyone had heard from a financial company before. It wasn't, give us money. It was, invest in the future of Stanford by investing in its students. You'll get a financial return, and you'll be directly helping the next generation of leaders from your own school. That mix of financial upside and genuine purpose hit differently. 40 Stanford alumni put in about $2 million combined. That money funded loans for roughly 100 Stanford students at rates no traditional bank would have offered them. Proof of concept done. In the fall of 2012, SoFi raised $77.2 million in its first major funding round. They immediately started rolling out to other top universities, using the same playbook: identify the alumni network, make the pitch, build the community. But now, they were showing up on the radar of the people they were disrupting. Traditional banks had enormously profitable student loan businesses. And SoFi's model was saying something dangerous out loud: banks aren't the necessary gatekeepers of money anymore. Communities, powered by technology, can finance themselves. That's not just a startup idea, that's a threat. By 2014, SoFi had funded over $1 billion in loans. The model was working. But the founders knew that staying in student loans wasn't going to be enough if they actually wanted to challenge Wall Street. So they made a decision. Go all in on becoming a one-stop shop for their members' entire financial lives. If you trusted SoFi with your student loans, why wouldn't you use them for your mortgage, your investments, your checking account? 2014 mortgages launched. 2015, a $1 billion funding round led by SoftBank. Personal loans followed. Then in 2018, they made a hire that sent a very clear message to the industry. They brought in Anthony Noto as CEO, former Goldman Sachs partner, former COO of Twitter. This wasn't a scrappy startup move, this was a company telling Wall Street, we're coming for you, and we're bringing someone who knows exactly how you work. Under Noto, the expansion went into overdrive. SoFi Invest launched stocks, ETFs, crypto. SoFi Money launched a cash management account with none of the fees that traditional banks quietly depend on. They were now competing on every front simultaneously. But here's the part of the story that usually gets left out of the inspirational version. In 2017, right as SoFi was hitting its stride and preparing to go public, the whole thing nearly fell apart. The New York Times published an expose describing the internal culture at SoFi as a frat house. Multiple employees came forward with allegations of sexual harassment, including claims directly involving co-founder and CEO Mike Cagney. Lawsuits were filed. More than 30 current and former employees reportedly came forward with accounts of misconduct. The board launched an investigation. Cagney resigned, effective immediately. And it got worse. The scandal was so damaging that SoFi had to withdraw its application for a bank charter entirely. Regulators weren't going to approve a banking license to a company imploding at the leadership level. The company that set out to build something more human than a bank had a serious humanity problem of its own. It took years to rebuild the trust. That context matters because everything Noto built after 2018 wasn't just expansion. It was a company trying to prove it had genuinely turned the page. Then COVID hit. And for a company built on student loan refinancing, the government's pause on federal student loan payments could have been catastrophic. It wasn't. Because they'd diversified fast enough. But the pandemic did something else. It created a window. While the world was distracted, SoFi made two of the boldest moves in fintech history. First, in 2020, they acquired a company called Galileo for $1.2 billion. If you haven't heard of Galileo, that's kind of the point. It's the invisible infrastructure, the digital plumbing that powers dozens of fintech apps and digital banks behind the scenes. Buying Galileo didn't just give SoFi control over its own technology. It made SoFi a vendor to the entire industry. Their competitors were now, in a sense, their customers. The second move was even bolder. Also worth noting, SoFi's path to going public wasn't straightforward either. They tried the traditional IPO route, couldn't make it work, and ended up going public in 2021 through a SPAC merger, essentially a backdoor listing, led by investor Chamath Palihapitiya, valuing the company at $8.65 billion. The stock debuted in the high $20s. For a company that was supposed to be disrupting Wall Street's old playbook, having to use one of Wall Street's more controversial vehicles to get there was a bit of an ironic footnote. In 2022, SoFi became a bank. The company that started as an alternative to banking, that built its entire identity around being different from banks, went out and acquired a small community bank to secure a national bank charter. And here's why that matters. Before the charter, SoFi had to borrow expensive capital from Wall Street to fund its loans. After the charter, they could use their own members' deposits, which is dramatically cheaper and more stable. The disruptors now had the same structural advantages as the institutions they were disrupting. Except they were faster, cheaper, and didn't have 50 years of legacy technology dragging them down. So, how does SoFi actually make money? Because that's the question that gets glossed over in a lot of fintech stories. 3 ways, mostly. First, interest income. Now that they're a bank holding deposits, they lend that money out and earn the spread between what they pay depositors and what borrowers pay them. Second, fees from their technology platform. Remember Galileo, that B2B infrastructure. Business charges other fintechs to use its plumbing, and it's become a meaningful revenue line. Third, product fees across their consumer offerings, credit cards, investment accounts, insurance referrals. It's a diversified model now, which is exactly what saved them during the student loan moratorium. Today, the numbers speak for themselves. SoFi is publicly traded on the Nasdaq. 1 million members in 2020, over 10 million by the end of 2024. Through September 2024, members had paid down over $33 billion in debt and borrowed over $117 billion to chase their goals. The one-stop shop vision is real now. Through a single app, student loans, mortgages, personal loans, auto loans, stock trading, crypto, high-yield savings, credit cards, insurance. A full financial supermarket built for people who do everything on their phones and have zero patience for the way banks used to operate. The SoFi name is on a stadium in Los Angeles that hosts Super Bowls. That's not a vanity play, that's a brand that has genuinely earned a seat at the table it once tried to flip over. But it hasn't all been smooth sailing recently. The stock debuted in the high $20 seconds after the SPAC merger, then created bottoming around $4 to $5 during the fintech winter of 2022 and 2023 as interest rates soared and the student loan moratorium dragged on. SoFi only hit its first full year of GAAP profitability in 2024, 3 years after going public. As of early 2026, the stock is trading around $17 to $19, still well below its peak. The company hit a milestone of its first billion-dollar revenue quarter in Q4 2025, which is genuinely significant. But for long-term investors who bought in at the top, it's been a frustrating ride. The story isn't over, it's still being written. Here's what stays with me about this story. They started with $2 million from 40 people who believed in the idea. Not a hedge fund. Not a big bank. 40 alumni who thought, yeah, this makes sense, let's try it. That first loan, funded by a community that bet on human potential instead of credit scores, is still the whole philosophy of the company. Everything that came after the bank charter, the stadium, the 10 million members grew directly from that one principle. You don't need a Wall Street address or 100 years of history to reshape an industry. Sometimes all it takes is 4 students, a borrowed $2 million, and the willingness to ask why things have to work the way they've always worked. What do you think is the next industry overdue for this kind of disruption? Drop it in the comments, genuinely curious what you all are seeing out there, and if stories like this are your thing, subscribe to Stag Research. This is exactly what we dig into every week.